The bond market is predicting that we're going to get a very significant decline in inflation, thanks to the Fed, once again, I think, oversteering. I mean, I actually believe, before the inflation report today, I was of the opinion, very out of consensus, I was of the opinion that the Fed should not raise rates at all this month. Because there's accumulation, there's a lag on these things. They've already raised rates by about 225, 250 basis points.
Scenario where they're raising rates so aggressively, meaning just in the last 6.5 months, they've taken it from 0 to 2.5. We actually are talking about whether they're going to do 75 or 100, which is kind of panicked levels of raising rates.
I wasn't aware of that. That amazes me. Are you telling me that? No.
The Fed is raising rates very aggressively to combat inflation, which is, in my mind, one factor, but not the only factor. Raising interest rates are going to have a tremendous effect, a negative effect, on corporate revenues, corporate profit.
There's a very good chance that in the attempt to prove their credibility that they're going to overdo it. And I think at some point here, as I said back in April, they're going to push it until something breaks.
It's their fault. It's their fault. It's their fault. You have failed, and you will pay.
And I think the break will probably come through, equity prices, but could come in another place. It could come in the emerging markets. So, eventually this will end in tears.
You would have to be insane to be the Fed to see what the potential cliff we're on in terms of the economy if they continue to raise. You'd have to be insane to even consider raising if you cared about the economy.
The economy's slowing way faster than you think. Elon was tweeting about the deflation he's seeing yesterday. And so I think the risk has shifted to the Fed perhaps over-tightening.
And the marketplace has moved a lot since Jackson Hole and also since the CPI data. So you have a lot of nastiness already priced into the marketplace. And the issue really going forward is at what point will we see the Fed say that they're going to slow this down?
The fifth rate rise this year. It's the steepest increase in rates in history, certainly since Volcker. But the background of the country today is so different than it was when Paul Volcker was chairman. We have $30 trillion of debt, the nation. The increase 1 point, if he goes 1 point on the next week, that's $300 billion of incremental interest expense. $300 billion is half of the defense budget of the United States. It's a lot of money. So the 2 or 3 rates he's done is almost $1 trillion of incremental interest expense. Now, not all our debt is floating. I mean, the economy is breaking hard.
So, Barry, what if I said
confidence is also miserable?
You're a real estate guy. You love low interest rates. You even like inflation. So what do we expect?
So the inflation news is really on the ground, really coming in really well. And that's why I was shocked when Powell was sort of acting last Friday like things are just getting worse and worse and worse.
In the meantime.
Well, since I'm retired and I retired early, it hurts my shopping budget pretty much because now I have to draw a little more out of my savings to keep going.
The prices you see at the grocery store rose 11.4% since August of last year. That's the highest 12-month increase since the period that ended in May 1979.
But I think the reason for the pivot is going to be a massive amount of deflation in the system. It's already here. If you look at commodity prices, the gold price, for example, it actually peaked in August of 2020, and it's at the lower end of a 2-year range, while copper has broken down, oil is breaking down, lumber has crashed, iron ore as well. Freight rates out there are suggesting that the supply chains are loosening up quite significantly. The rates are coming down. So we've got deflation in the system. And the way I describe what's going on right now, I was in my early days in my career in the early 80s when Volcker was taking a sledgehammer to inflation because it was embedded in the system after 15 years of profligate spending, Vietnam War, Great Society, and then going off the gold exchange standard. A sledgehammer, that's what he needed. That is what I believe Chairman Powell thinks he needs. And we just don't think that's true because we see so much deflation, so much deflation.
All right. Today is Tuesday, September 20th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Did you like the intro of this video? All of these Wall Street rats panicking already. God forbid, interest rates are going too high. The economy is going to crash at 2.5%. Interest rates are too high. Are you kidding me? Meanwhile, the inflation rate is at 8.3%. But we know that inflation doesn't matter for these
people.
Criminals. That's what they are. Ladies and gentlemen, we're talking about over a decade of quantitative easing. Trillions and trillions and trillions of dollars added to the national debt, over $30 trillion. Where did you think that money go? It certainly did not go for infrastructure. Our infrastructure is crumbling all over the country. That money did not go in giving Americans free access to health care, or education, or affordable housing, or anything that improves the lives of the average American. That money floated right to the top. It is a theft. Steal from the future generation for present gains today, for the oligarchs, for the 1%, for the Wall Streeters, and the likes. And now it appears that America is heading into a lost decade. If you're a Gen Zer, you have these criminals to blame. They stole from you. That's what happened. And now all of a sudden they're panicking and they want the same racket to continue. Hey, Mr. Powell, the Fed, don't raise interest rates by too much because you'll crash our real estate values, you'll crash the stock market, and having high inflation is a lot better. Who cares about the poor and the middle class? These same oligarchs, by the way, had no problem whatsoever when the Fed cut interest rates from 150 basis points to zero in 1 month. They had no problem with that at all. They have no problem with the Fed cutting interest rates to zero, all the way from 5% plus in 2007-2009. But now they panic when we have an inflation rate at 8.3%, which we know it's a lot higher than that in real life, yet they're panicking about 2.5% interest rate. Folks, we're going to talk about this and a lot more in this program. And as you can hear, I'm already fired up and ready to go. So let's not waste any more time. And here it is, in focus tonight. Wall Street rats are panicking. They're sounding the alarm. They know the scam is over now. And let's begin with this. A reminder, this channel has been ahead of the curve from the get-go. Over a year ago, I've been warning repeatedly, if this continues, we're gonna head into a stagflation crisis. And once the economy enters stagflation, the Fed is out of options. Stagflation is the worst economic phenomenon possible for any economy because it leaves permanent damage, and getting out of stagflation requires a lot of pain. You know, the bulls and the market pumpers, all the way till the latest CPI reading, they've been saying that the stock market will move higher, the economy will experience a soft landing because the Fed will pivot since we have peak inflation. They got one reading of the CPI and they couldn't wait to start jerking off to it. Prematurely, of course, because the next CPI reading was nothing short of a wake-up call that the peak inflation bullshit is not valid at all. So now the bulls and the pumpers are shifting to another strategy, which is, but if the Fed continues to increase interest rates to tackle inflation, the economy will head into a recession. Recession risk. The Fed cannot increase interest rates anymore, otherwise we're gonna head into a recession. The recession is already here. Same people who've been telling us a soft landing is coming. Same people who told us that the economy is not in a recession because look at the unemployment rate. Same people who said inflation is gonna be transitory. Same people who said peak inflation. Now they're panicking about a recession. They want any excuse to make the Fed back off. Why? Because all what they care about is their real estate value and their equities value. That's all. They don't give a rat's ass about inflation. Inflation impacts you, the poor, the middle class, the average Jane and Joe. But it doesn't really impact them that much. It's actually good for the 1%. It's good for Wall Street. It's good for the oligarchs. And here's the problem, folks. We've been saying to the Fed since last year, Mr. Powell, start tightening now. The longer you wait, the more dangerous this game becomes. Why? Because this is what happens under stagflation. Inflation remains high, as we're seeing right now, yet the pace of economic activity starts to slow down significantly. And we're seeing this from PMIs all over the place. We're seeing it from consumer sentiment. We're not seeing it yet in employment, but we're about to see it. And of course, the recession risk rises higher as the Fed continues to tighten the monetary policy to defeat inflation. What happens if the Fed says, okay, we've done enough. We know that raising interest rates has a lagging impact. It shows up later. We're seeing enough damage in the economy. 8.3% inflation is pretty good. Let's ease up here and pause a little bit on the hawkishness. Maybe do a 50 basis points increase tomorrow and then do another 25 and then wait and see. Here's what's going to happen. Yes, the pace of economic activity will move higher by a little bit. The recession risk will move down a little bit, but inflation will move higher again. And then the Fed will realize that their strategy is wrong. They play catch up once again. They raise interest rates aggressively higher. What happens? Inflation goes down, but now the pace of economic activity is absolutely crushed. Hence, the recession risk becomes alarmingly high. And the economy at that point could head into a massive recession, if not a depression. And of course, all eyes are in D.C. tomorrow. The big dog, Jerome Powell, the FOMC, the decision by the Fed, the criminals over there, and of course the conference from Clown Powell. And we are now eyeing perhaps the largest Fed rate hike in 40 years since the Volcker era. And this is what these Wall Streeters are upset about. Even though, forget about the CPI, aka the CPLI, at 8.3%. Even the Fed's favorite measure, the PCE inflation, which is even worse than the CPLI, is way above the Fed funds rate and certainly way above the inflation target of 2%. PCE inflation sits at around over 6%. Now, we know that the real inflation rate in the economy is at 18%, if not even more. And now that you've heard from the pumpers, let's hear from the hawks and those like me who say that the Fed should not back off, that the Fed should actually double down, even if the outcome would be a recession, because doing it now is a lot better than waiting and doing it later and risk a prolonged recession, if not a depression. Larry Summers urges the Fed to keep raising interest rates and warns that hiking too slowly risks an economic disaster. What is he talking about? Summers highlighted that even Paul Volcker, who famously vanquished elevated inflation as Fed chair. And listen to this. Paul Volcker had a kind of a false start, as recounted in a recent opinion piece by former Fed Governor Frederick Mishkin. And pay attention now. In response to weakening economic data, Volcker relaxed the Fed's stance in the spring of 1980, which then had to be reversed later, generating higher interest rates than would otherwise have been needed, he said. In other words, even Volcker panicked in response to weakening economic data, and he took his foot off from the tightening pedal, and guess what happened? Inflation moved higher, and he had to raise interest rates again even more intensely. Are you listening, Mr. Powell? And now let's hear more sober, rational takes, this time around from Shri Kumar. Take a listen.
To gain back credibility, he really has to crush the economy, increase the unemployment rate, and it is not something we want, but that's what he's leading up to, and that's essentially what he has to do, 1.25 percentage points to show that he's in charge. It doesn't just matter if he keeps quoting Paul Volcker all the time. That will not bring inflation down. He has to act like Paul Volcker.
So Shri Kumar says 1.25% tomorrow. I actually say 1.5% tomorrow if Jerome Powell is actually serious about tackling inflation. But of course he's not, so he's not going to do the 125. But if you thought Shri Kumar is crazy, maybe he's crazy as a fox, but not as crazy as the next take from legendary investor Mobius. Take a listen.
There's no question that the Fed has a game plan. Their game plan is to make sure that the interest rate is higher than inflation. That's the way they believed the way to kill inflation. So you have 8% CPI, that means you have to have 9% interest rates. So we're going to see higher and higher rates if these CPI numbers keep on coming this way.
Wait, hang on, Mark. 9% interest rates? Is that where you see the peak?
Yes. If the inflation is 8, the Fed has to raise the interest rates higher than inflation in order to kill inflation.
So he says 9%, and he's not being crazy. He's actually being sober. Volcker increased the interest rates, the Fed interest rates, above the CPI. This is how he defeated inflation. So if these Wall Streeters think that 2.5% is it, they're going to kill inflation at 2.5%, forget about it. It's never going to happen. inflation will pop higher again. Now, am I saying that the Fed should raise interest rates all the way to 9%? I'm not saying that. I'm saying at least to 5%, so you can at least have a fighting chance against defeating inflation. Because the risk of doing nothing, the risk of kicking the can down the road, is what's going on in countries like Argentina, where the inflation rate is at 100%, and Argentina hiked interest rates by 75%. Would you like to see what hyperinflation looks like? Because that's the other alternative. And the longer the Fed waits in the fight against inflation, the more risk develops in the economy. And perhaps the biggest one, the one that could pretty much cripple the entire American economy, is this. As inflation continues to rise higher, Americans are resorting to using their credit cards and taking more debt, swiping those credit cards up and down, up and down, up and down, with no mercy at all. And the problem is, they're stuck with it. About 60% of those who have credit card debt, they tend to carry that debt for at least 1 year, 60%, 40% for at least 2 years, 28% for at least 3 years, 19% for at least 5 years, and 8% don't know. 8%, daddy pays, so they don't care. But perhaps daddy is in for a surprise. Not a pleasant one this time around, because Americans keep running up those credit cards up and down, up and down, up and down. And listen to this. The average variable credit card interest rate is now at 18.03%, up from 16.1% in June. That is expensive, especially if you are one of the more than 3 in 5 Americans, 61%, who are already grappling with debt. And credit cards, of course, are the biggest culprit, 70%. And this is, of course, according to LendingTree. Now listen to this. The most common reason for those already carrying a debt load, 30% necessities, 26% emergencies, 25% say health or medical issues. What a shame. We live in the richest country in the world, yet somehow we have to go in debt for basic medical issues because, the country cannot afford Medicare for all. The country cannot afford easy and cheap access to health care for its population, but the country can afford trillions and trillions and trillions of dollars to bail out Wall Street, to fluff up the stock market, to fluff up the real estate market, to benefit who? The owner class in this country. And folks, we have a consequential meeting tomorrow by the Fed. Whatever they do will determine where the economy goes from this point on. Are we going to see prolonged stagflation by the Fed not doing the job? Or are we going to see the beginning of a massive crash in the economy and the stock market because the Fed has to tackle inflation and do whatever it needs to be done to defeat inflation, even if that means a recession?
Some men just want to watch the world burn.
Now, market expectations have moved dramatically higher when it comes to the Fed rate hike. Before the CPI, the expectations were for 50 basis points or even 25. Now the expectations say at least we have 75 basis points in the bag, already baked in the cake. But is it possible that we could see a larger than 75? For example, could we see 100 basis points? A lot of folks are skeptical and they say, the Fed will never do that. The Fed cannot afford to do that because fill in the blank. We'll listen to criminal Clarita. Remember that one? Insider trader Clarita, who got caught with a crime. What does he do? He retires. That's the punishment. The man should be in jail, but he's not, because he's above the law. So we have to listen to him. This is what he said.
The message I got is very clear. Failure is not an option to Jay Powell. So I think the uncertainty is how high will rates have to go and how long will they have to stay there to bring inflation down into the 2s. But you got to believe the Fed now. I think they've made that very clear. And I've been surprised how unified the messaging is among other members of the committee on this point. So you got to believe the Fed.
And therefore, folks, I have little reasoning that the Fed will say, hey, folks, we're not going to do these 75 basis points. We'll do 50 or 25 because the Wall Street oligarchs are barking. You know what's even riskier than Wall Street oligarchs barking? When the population starts to rise. We know with prolonged inflation, this is always the result. Anger among the population boils up and we see uprising, massive uprising. We're already seeing them in Europe. We saw them in Sri Lanka. We're seeing them in Africa right now. We're seeing them in South America. And soon enough, they will be here in North America. But let's do a scenario analysis. The consensus for now is Jerome Powell comes out plain vanilla. Plain vanilla means 75 basis points because that is the consensus right now. Will the market move one way or the other based on the 75 that we all are anticipating? Of course not. If it is 75, then all eyes and ears will move to the conference, and the algos will be looking for words such as data-dependent, relaxed, flexible, anything that hints that Jerome Powell is pivoting, and the stock market will blast significantly higher. However, if Jerome Powell says, hey, 75, and we could do another 75, we could even go larger, depending on the CPI or whatever inflation data that he's referring to, then the market could go down big. Now, let's say right off the gate, Jerome Powell comes out chocolate. And by chocolate, we mean 100 basis points. Market crashes, it goes down big. Let's say Jerome Powell comes out strawberry with the 50 basis points. It's not likely, but if it happens, the stock market will blast higher like you've never seen before. And of course, it all depends on the dollar and yields. We talked about scenario analysis on Sunday for both the dollar and yields. The dollar moves down if indeed the Fed is easing, meaning 50 basis points or 75, but with the openness of a pivot. Or the dollar is going to surge significantly higher if Jerome Powell goes chocolate with 100 basis points, or he does the plain vanilla 75 and then hints for more in the conference. And folks, frankly speaking, we are at this stage in the economy where the chicken have to come home to roost. We've been in at least a decade of quantitative easing. Easy money all over the place. Everybody's a genius. You buy any stock out of a hat and 9 out of 10 chances it will go higher in the next few years. Everybody in the business is a genius. But when the easy, funny money goes away, the time arrives for all of these fake money managers, phony hedge fund managers who looked like a bunch of geniuses because all what they had to do is buy stocks, go long. The Fed is buying. Is it really a surprise that the stock market went higher? And all of these hedge funds and the phony money managers, they receive billions and billions of dollars from state funds, from retirees funds, from pension funds, and they get to roll in cash. Cash borrowed from the future generation. But now when the easy money goes away, this is the time when we know who's the real deal and who are the phonies, which, by the way, 99% of them are phonies. Listen to Nassim Taleb, who has a really interesting take on this.
Think about it. No interest rates. So anyone who's today 40 years old, like 40 years old with no experience of markets.
Right.
With zero, they don't know what time value of money is.
Okay.
So the Fed overshot by lowering interest rate too much. The first 100 basis points work, the second much less. At zero interest rate now, of course, for a long period of time, you are hurting the economy, you're creating bubbles, creating tumors like Bitcoin, creating
tumors like Bitcoin.
Yeah, or hedge funds that should not exist but have existed for 15 years.
And I love this analogy because with quantitative easing, easy money all over the place, all of these tumors and cancerous cells start to develop all over the place, all over the economy. Risk all over the economy. Well, now you have to unplug the cord all of a sudden. What do you think will happen? In order for the Fed to remove all of that risk, all of these cancerous cells out of the body of the economy, at this point, they cannot do it surgically. They have to do it by chemo. Well, guess what happens with chemo? It destroys the good, the bad, and the ugly, not just the cancerous cells. And this is where we are right now. It is inevitable. It is inescapable at this point. And if you thought recession is the worst outcome, I got more bad news for you. Recession is nothing, because we're now talking about a lost decade, just like we saw with Japan. We might see a lost decade here in the United States. And this is not just me saying that. Even Stanley Druckenmiller says there is a high probability, quote unquote, the stock market will be flat for an entire decade. Oh boy. And folks, before we move on, since we're talking about inflation, I don't know if you heard on Sunday the 60 Minutes interview with Joe Biden, and President Joey B decided to downplay inflation. Absolute disaster, a PR disaster for him and the Democrats. Why would he say something like this publicly? Out of touch, out of mind. Take a listen.
Mr. President, as you know, last Tuesday, the annual inflation rate came in at 8.3%. The stock market nosedived. People are shocked by their grocery bills. What can you do better and faster?
Well, first of all, let's put this in perspective. Inflation rate month to month was just an inch, hardly at all.
You're not arguing that 8.3 is good news.
No, I'm not saying it's good news, but it was 8.2 or 8.2 before. I mean, it's not. Maybe I can make it sound like all of a sudden, my God, it went to 8.2%. It's
the highest inflation rate, Mr. President, in 40 years.
I got that, but guess what we are? We're in a position where for the last several months, it hasn't spiked. It is just barely, it's been basically even.
And you know what? Since Joey B is downplaying the nature of inflation, I'd like to play a game. And this game is called Think About What You Think About.
Think about what you'd think about.
Think about what you think about.
And I say, Mr. President, look at food inflation year over year. Fruits, vegetables, 9.4%. Poultry, 15.9%. Dairy, 16.2%. Cereal, 17.4%. Fats and oils, 21.5%. Put yourself in the shoes of the average Joe and Jane. Put yourself in the shoes of the retiree on fixed income. And think about what you think about, man.
Think about what you think about.
Think about what you think about when you see these price increases. And if you thought this is bad, take a look at the month over month. We're talking about month over month readings. Cereal, 1.2%.
Think about what you'd think about.
Sugar, 2.4%.
Think about what you'd think about.
Flour, 2.2%.
Think about what you'd think about.
Ham, 1.3%.
Think about what you'd think about.
Potatoes, 2.5%.
Think about what you'd think about.
Bread, 2.6%.
Think about what you'd think about.
Canned fruits, 3.4%.
Think about what you'd think about.
Margarine, 7.3%.
Think about what you'd think about.
Eggs, 2.9%.
Think about what you'd think about.
Olives, 4% worth of inflation month over month.
Think about what you'd think about.
Think about what you think about. Anyways, we have to move on here and cover the stock market for you. So let's start with the closing of the indices today. And here we go. The Dow Industrial Average down by 313.45 points, or a decline of almost 1%. The Nasdaq down by 109.97 points, or a decline of 0.95%. The S&P 500 down by 43.96 points, or a decline of 1.13%. What about the sector's performances today? Pathetic across the board, shame on all of them. No medals today in the laggers led by real estate, materials, and cyclicals. What about the advance to decline ratios? NYSE 13% advancing versus 86% declining. The Nasdaq 24% advancing versus 72% declining. Now this is actually a favorable setup for the bulls because the element of surprise becomes to the upside, meaning even if Powell does the 75 and keeps his mouth shut, we could see the market rallying higher on the technicals alone because the setup is down we go. But what if the opposite happens? The setup now says the risk is to the upside. Of course, this is not what the bears want to hear. The bears would have actually loved to see the stock market up big heading into the FOMC because that makes the risk to the downside. Anyhow, moving on to futures, commodities. What's going on here? No notable action for energy commodities today. Yes, crude was down by a little bit. Natural gas was down by a little bit, but it is the anticipation of what the FOMC is about to do. It's all about the dollar. If the dollar goes down, we will see a significant rally in commodities. Why would the dollar goes down? Less hawkish Fed. Less hawkish meaning Jerome Powell comes out strawberry or he comes out vanilla, but he adds some sprinkles by saying, hey, I'm aware that there is a risk. We're going to be data dependent. We're going to look and see. We're aware with what's going on, yada, yada, yada. Then you'll see the dollar going down along with yields, and this will be really good for commodities, but specifically metals. Of course, the opposite is true. If Jerome Powell comes out chocolate, commodities will go down big, specifically metals. But for today, we got a rally in softs, lumber up big, almost 7% for the day. Likewise, sugar, coffee futures, all scoring gains of a little over 2% for the day. OJ a little behind at about 2% worth of gains. And then we have the laggards, cotton futures down big, a little over 3%, along with cocoa down a little over 1%. Metals, muted action in anticipation of the dollar. We're not going to make a big deal out of anything here. When it comes to meats, muted action, the calm before the storm, yet we have feeder cattle futures down by about 1.25%. But look at this, grains were blasting higher today. Wheat futures gained over 7% worth of gains today. Can you imagine you're Jerome Powell right now? You're looking at wheat up 7% in a single day. You say, yeah, we have peak inflation. Not going to happen. Not going to happen. Anyways, besides wheat, we have decent gains for corn, about 2%, soybean meal futures up about 2.5%, and soybean oil up about 1% apiece. Rough rice, oats, flattish for the day along with canola. No major moves here. Moving on to the big casino, the options market. What's going on here? The volume got slightly elevated here, specifically for the two largest names, Apple and Tesla, neck and neck at number 1, number 2. Apple came up barely at number 1 at around 1.6 million contracts, but look at this, they're buying more puts. About 54% of those contracts traded today were puts, not calls. Tesla, the souffle, at number 2, with around 1.6 million contracts traded today. And unlike Apple, they continue to buy calls for Tesla. About 52% of those contracts traded today were calls. Look at this, Ford at number 3. Ford was down big, another massive macro warning by Ford. And the stock was down double digits today. About 765,000 contracts traded for the name today. About 56.5% of those were calls. And here are the unusual activities that took place in the options market today. We start with the ticker GDX. This is for the gold miners. Somebody's buying calls, so what are they saying here? They're saying the dollar is going to go down tomorrow. Why would the dollar go down? It would go down because the Fed is less hawkish than expectations. And this somebody bought the 25.5 calls for the expiration date, October 21st, with expectations that the GDX could bounce higher and gain over 7% by then. They paid around 60 cents apiece to enter this trade, all in all spending around $1 million. And what about the ticker EQNR? This is a company called Equinor. It is the Norwegian state oil company. And believe it or not, while the UK, Germany, Italy, Spain, all of these European economies are in shambles, the Norwegian economy is doing pretty good, at least for now. And the reason is they're a net exporter of energy. So you look at the stock of EQNR, for example. This is a monthly chart. Doesn't look like anything in the stock market right now. The stock is about to make all-time highs. Now, is this a double top and down we go from this point on? I'd leave that to you. But the bottom line is we have an outperformer here. And it tells you a story about the Norwegian market. It tells you a story about the energy dynamic in Europe. Not all countries are losers. The net importers are, not the net exporters. In this case, somebody sees more gains to come for the name, and they bought the 37 calls for the expiration date, October 21st, with expectations that the name could move higher and gain more than 7% by then. They paid around 85 cents apiece to enter this trade, all in all spending around $1 million. And then what about the ticker LVS, Las Vegas Sands? Used to be Las Vegas, now it's Macau. They sold the Venetian and the Palazzo, so they have no ties to Las Vegas. And you know, for me, I spent my entire career in Las Vegas, in the casino industry pretty much, before I pivoted, that's the pivot, to financial markets, but before that I did casinos. And Las Vegas Sands was one of the best run companies on the Strip. Say what you want about Sheldon Adelson, but he knew how to run a company, a casino company. While everybody and their mothers wanted to charge fees for parking, for Wi-Fi, for breathing oxygen, Las Vegas Sands said we're not going to do any of that. But now the stock is beaten, bruised. Some would say maybe we've seen the bottom in this name, since we're seeing more stimulus in China, and perhaps with that, the revival of Macau. And therefore, somebody bought the 44 calls for the expiration date, November 18th, with expectations that LVS could move higher and gain more than 12% by then. They paid around $1.60 apiece to enter this trade, all in all spending around $1.5 million. At the bottom of the table, what about the ticker VERO? Or for the company Vero, an underperformer year to date, but somebody's betting that perhaps we've seen the bottom, and perhaps we're about to see a rebound coming, a big one. They bought the 14 bucks calls for the expiration date, November 18th, with expectations that the name could rebound and gain more than 18% by then. They paid around $3.30 apiece to enter this trade, all in all spending around $3 million. Continuing with interesting trades, what about the ticker ZIM? A lot of you love this stock, ZIM, and the reason is I talked about it before, and I actually bought the stock before. I used to be long ZIM, but then they wanted to crush shipping rates, and the Fed started tightening, and you know the rest of the story. And now somebody sees more pain to come for ZIM. They bought the 25 puts for the expiration date, November 18th, with expectations that ZIM could go down and lose more than 13% of its value by then. They paid around $2 apiece to enter this trade, all in all spending around $1.5 million. And then what about the ticker LLY, Eli Lilly? Somebody sees more upside coming, and they bought the 332.5 calls for the expiration date, October 21st, with expectations that the name could move higher and gain more than 10% by then. They paid around $2.5 apiece to enter this trade, all in all spending around $1.7 million. And lastly, at the bottom of the table, what about the ticker AAA, double APL for Apple? More bets against Apple by the day. Somebody bought the 148 puts for the expiration date, October 21st, with expectations that Apple could move down and lose more than 5.5% of its value by then. They paid around $3 apiece to enter this trade, all in all spending around $1.5 million. Moving on to the heat map analysis, speaking of the devil, Apple was the only notable outperformer today. It was hand in hand with Tesla, and I actually took a screenshot. I don't know where it is right now, but midday I took a screenshot. Pretty much everything was in the red, with the exception of Apple and Tesla. And I thought to myself, isn't this really ironic? Since last year, I've been saying, And it's not just me, by the way. Even Grantham been saying the same thing. The last 2 blocks to fall will be Apple and Tesla. That's how you know the crash has started, the epic finale, and we're getting closer to the bottom. We haven't seen the bottom yet until Apple and Tesla go down. And it was really ironic today that Apple and Tesla were kind of an outperformer. Tesla went down later in the day. Apple maintained some of the gains. But besides that, everything's down. So we have to talk about corporate news. What about NVIDIA? You know Jim Cramer? Yesterday he said that he's going to short NVIDIA. Not just he's not bullish anymore or he's bearish. No, he's going to go short NVIDIA. Now, if you are a firm believer in the inverse Cramer ETF, then you should go all in buying NVIDIA calls. But pay attention here. There is something in the business that we call the Jim Cramer phenomenon, and it happened back in 2008. Jim Cramer, at around July, August of 2008, became bullish again, called the bottom. And what do you know? From that point on, the stock market started to crash. But around September, October, Jim Cramer came out and said that he's selling everything. He's done. And guess what? He was right. Because after that, the crash happened. So is the Jim Cramer phenomenon going to hold this time around? He was bullish in the summer, called peak inflation, called the bottom, called the bear market over, and now all of a sudden he's becoming bearish again. This time for real. So when Jim Cramer says sell everything, is it going to be 2008 once again and Jim Cramer will be proven right? Or will the inverse Cramer ETF holds? We'll see. And then we have news about Moderna. You might have heard that Moderna was down big yesterday. It rebounded higher by a little bit today, but the reason is, back to the Sunday interview with 60 Minutes, Joey B said that the thing is over. Oh, the thing is over now? We knew it was over long time ago, but it was politically feasible for him. Now it's no longer feasible. You know, we have the November phenomenon, so all of a sudden the thing is dead. With it, Pfizer and Moderna and all of these big pharma stocks. And then we got news for Lockheed Martin. I continue to hold the name in my long portfolio. I continue to be bullish because you're not going to have recession for Lockheed Martin. If anything, we will see more wars, more conflicts, more escalations, and this time around we have Switzerland, of all countries, now signing a deal with Lockheed Martin to buy F-35A jets. No recession here, folks, but there is a recession here in Bed Bath & Beyond, also known as Blood Bath & Beyond. They're already closing stores, and folks, this story is not over. Not even close. Ryan Cohen is silent right now, but this story is about to heat up again. Big time. Cohen is not going to get away with it. Watch. And then we have the news from last week regarding Gap. I did not cover this story, so I'm going to cover it now. Kanye West and Gap are done. Split. Divorced. Just like him and Kim. They're done. Well, at least Kim is. He's not done yet. But I watched the interview with Kanye West on CNBC, and you know what? The guy's actually creative. And when he hired Kanye West, let him do his thing. Total autonomy. The problem is, and this is why this deal was dead upon arrival, Kanye West wants to manufacture shirts at $5, $10, $15 a piece, but he wants to sell them at $500 a piece. Now, Gap is a value store. They cannot do that, and hence the conflict. So the deal is done now. Kanye is going to go his way, but Gap is going to go the way of bankruptcy. And then we have to follow on in the story of the hackers. We talked about Uber, what happened last week, along with Zoom. And this week we have a new victim, Take-Two. Apparently Grand Theft Auto 6 was leaked online. And now we know that it's going to be the woke version of Grand Theft Auto. You know, instead of hitting people with guns and baseball bats, you smack them with coloring books. But anyways, this is becoming a major story. Hack after hack after hack. What is the end here? And is that a catalyst for stocks such as cybersecurity stocks, CrowdStrike, or Fortinet to move higher? Something to think about. Even though I'm short CrowdStrike, by the way. But anyhow, we have bad news for Jerome Powell here. American Express is on the hunt for software engineers, coders, and developers. Listen to this. Part of a 1,500-person hiring spree. So Jerome Powell wants to see higher unemployment. I say good luck, Mr. Powell. And here's the heat map for the ETFs, a bloodbath across the board. No surprise here. We have few exceptions, and the exceptions are the inverse ETFs, the VIX proxies, and the EWZ, the Brazilian ETF. This is about to become really, really volatile as we head into the elections in Brazil. Bolsonaro versus Lula. And regardless of the outcome, who's going to win doesn't matter. The end outcome is the same. How about civil war? You thought America is divided? Go take a look at Brazil. But anyways, there's nothing to look at here. Pretty much everything is in the red, so we have to move on to the charts analysis, and we start with the SPY, the S&P 500 30 minutes chart. Unfortunately, there's nothing to see here either. On Sunday, we talked about the market could be moving higher Monday, Tuesday, but the market will be flattish and hesitant before the FOMC. The market maker will use the opportunity in hedging either way for the upside potential or the downside. and that could suppress any move after the FOMC, absent of a massive surprise, such as 100 basis points or even 50. But if it is 75, we might see a relief rally if Jerome Powell adds a few pieces of M&M on top of the vanilla ice cream by saying, hey, I'm going to be data dependent. Well, here's some data for you, Mr. Powell. Inflation is at 8.3%. And by the way, rent inflation is at 40% in real life. But anyhow, the chart of the SPY is having a hard time, really hard time, passing over 385 as resistance. Some would argue that the formation we saw today is the beginning of an ABC formation that would take us to the downside. My response is too premature. You don't know that yet. You have absolutely no clue. It's all about the FOMC and how the dollar and yields are going to react. So stop it with the predictions, because you're not going to nail it, and if you do, it's going to be because of luck. For now, we are prepared for both outcomes. We know if Jerome Powell comes out vanilla, or better yet strawberry, the dollar moves higher along with yields, or we're going to go long metals. We're going to go long tech, chips, etc. If Jerome Powell comes out chocolate, or let's say French vanilla, 75 and then more hawkish talk, then down we go. And we're going to short metals, short tech, short the XHB home builders, etc., etc. Now, you might say, hey, Maverick, why wait after the move? You don't have to wait after the move. You can have what I call the initial positioning, both ways. And if you believe that the outcome will produce a massive surprise, a sizable move one way or the other, your losing hand doesn't matter, because your winning hand will score extremely big. Now, this happened last week. This strategy worked last week in the aftermath of the CPI. Why? Because the market maker and the consensus was in one direction. The market maker was positioned for the market to go higher after the CPI, because the consensus was CPI will come out cool and confirming peak inflation. The market maker got caught with their pants down when the CPI came out too hot, and hence the sizable reaction to the downside. You might not see this phenomenon this time around. Why? Because the market maker learned their lessons from last week. Now, what about the daily chart for the continuous contract for the S&P 500? The bad news is the volume is still above average. The momentum indicators remain negative for now. The bulls did not make it at above 3,960, but the good news for the bulls is the following. The support of 3,855 remains intact for now. Keyword, for now. So the daily chart of the SPY, the bias is still to the downside. The bulls have to do a lot of work here for us to say, okay, we're out of the woods. And here's the 30 minutes chart for the Qs, the NASDAQ, similar phenomenon. Sideways, no major move at all, and the chart is having a hard time at 290. Some would argue we have an inverse ABC pattern. Take it easy. You don't know shit. You'll know when you know, after the FOMC. If we go down, the likelihood is we'll get closer to the June bottom. If we go up, the likelihood is we're going to blast at resistance number 1, 294. Then we have the trend line, and after that we have at around 300. And here is the daily chart for the continuous contract for the NASDAQ. The good news for the bears, the volume is still elevated, kind of, to the downside. The momentum indicator is still in negative divergence. The bulls don't have the energy right now to even get us above 12,207. The good news for the bulls, they continue to hold on the support right before the June bottom at around 11,689. Another piece of good news for the bulls when it comes to this chart is it appears that they're forming what it appears to be, at least for now, a saucer bottoming formation. This formation goes out of the window the moment the futures contract breaks below 11,689. IWM, Russell 2000, what's going on here in the 30 minutes chart? Nothing is going on. Still facing the same resistance at around 178.60. We're not going to even bother identifying any support. If we go down big, a flush down. It stops when it stops. But if we do go up, we have the gap, that is target number 1. Then we have 181. And after that, 183.25, and at that point, it's going to be a stretch. Yet this is the most important chart to watch, the Dixie, the dollar index, for now. The formation became a little bit more bullish for the dollar, of course, not for the market. It became actually more bearish for the market today because the bull flag formation that we talked about in Sunday's video, it appears that it is playing out at least for now. And all of that consolidation for the last few days eased a lot of the so-called overbought conditions in the momentum indicators for the Dixie. What does that mean? It gives the Dixie a little more room to pop higher if it wants to do so, unlike the charts of the 10-year yield and the 2-year, as you'll see in a minute. Now, the weekly charts, the monthly charts of the dollar, all saying that the dollar is perhaps peaking. Now, that doesn't mean that we cannot see a pop or two before that happens, because the daily chart right now indicates more gains to come for the dollar. So what the bulls are asking from Powell tomorrow is slay the dollar. Get the dollar down. And believe it or not, Jerome Powell wants his cake and eat it too. He wants inflation to go down, so he wants to tighten the monetary policy even more, but he also wants to crush the dollar. Can he achieve that objective? We'll see. But for now, the bias says more upside for the dollar. These are the technicals, not the fundamentals. The fundamentals could say otherwise tomorrow. And if they do, if the dollar goes down, it will be good news for what? For metals, aluminum, copper, steel, but most importantly, gold. Here's the chart of gold. It is bearish for now. It is consolidating below 1,685, lost an important support here, and it is consolidating for what? For the next leg down. If the dollar pops higher tomorrow, gold will go down big. What is the risk versus reward right now looking at this chart alone? The risk is to the downside. And the reason is gold already broken an important support of 1,685. If it was trading above this number, we would have said, okay, there is a possibility, a great one, that the dollar goes down and gold pops higher again. We have the double bottom, triple bottom at around 1,685. But the fact that it is below this number is a big problem for the bulls. What about Brent oil, the daily chart? What's going on here? The potential of a reverse head and shoulder is still here. The potential of a higher low is still here. So for now, we're giving the benefit of the doubt for the bulls. And if the dollar goes down big tomorrow, you'll see a massive pop in oil above the sloping line of resistance. If the dollar pops higher big time again, because Jerome Powell came out chocolate, Brent oil will likely break the support, the important support of 85. And here's the second most important chart for the week, for the day, the 10-year yield. The problem for the bulls is it broke above an important resistance of 3.5. If it stopped at 3.5, we would have said, okay, the bulls have hope here. This chart is saying that Jerome Powell will come out easing, not easing the policy, but easing the hawkishness. We could see the 10-year down and the NASDAQ up tomorrow. But the fact that it is above 3.5 is problematic. But here's the good news for the bulls. Equities bulls we're talking about. The momentum indicators are highly elevated right now. That doesn't mean that the 10-year should go down, but it means that the risk is to the downside. The surprise element is to the downside. Any hint that Jerome Powell is pivoting or easing, you will see the 10-year yield flushing down big time. It might erase 3, 4, 5, 6, 7 candles at once from prior days. This is how the RSI and the momentum indicators play out. But perhaps more important than the 10-year is the 2-year yield, right now sitting at around 4%, but the RSI, the MACD, all elevated, the daily chart. That doesn't mean that it should go down. It could pop higher again. And it has plenty of room to shoot up higher from a weekly or even a monthly perspective. But on the daily, the risk is to the downside. So watch out for this one. And if the 10 and 2 years go down, but specifically the 10, the TLT, here is a weekly chart, we will see a pop higher. The question becomes at that point, can the bulls break above 109.5 and close above that for the week? That would be a turning point for the TLT. The VIX 4 hours chart, what's going on here? On Sunday's video, we talked about the short or the 4 hours chart for the VIX as being in the bulls camp. And the reason is the momentum indicators were curling down and we saw negative momentum in the VIX for a few days. But now look at the MACD. It is curling its way higher. So the problem for the bulls here, market bulls that is, the VIX is turning bullish, not just from the 4 hours perspective, but also from the weekly perspective. Look at the MACD indicator. We have a crossing indicating a big pop about to happen. So when we wrap it up at the end of this segment, we're going to talk about the VIX and many other charts. Are they in the camp of bulls or bears? Here's another one, Apple, the daily chart, a big pop today. But it stopped at 157, an important number. Used to be important support, now important resistance. Now the bulls, or shall we say the market maker, did a lot of repair for Apple. And the reason is last week they held massive bags. All of these 160, 165, 170 puts expired in the money, meaning the market maker is holding a massive bag. And it is in their interest to pop Apple higher, at least for a day or two, get it closer to 160, and then dump and reduce the losses from last week. We'll see if this is the strategy by the market maker or do we have a tide shift here and the bulls are hopping back in and buying Apple. We'll know that if Apple closes the week above 157. For now, the volume moved higher on a buying day. That's good news for the bulls. The momentum indicators are curling their way higher, about to cross in the MACD and produce positive impressions in the histogram. I would say Apple is in the bulls camp, at least for now. But if you peel the layers of onion and you remove the market maker out of the picture and you see how many people buying puts on Apple, these large type bets, you know they know something. And Apple will go down sooner or later. And we're not just talking 5%, 10%, we're talking 20 plus. Anyways, here's Tesla, an hourly chart. On Sunday's video, we talked about Tesla being bullish on the hourly chart, on the daily, on the weekly, but the monthly remains a problem. Now, the hourly is becoming slightly bearish, and the reason is they stopped at the triple top, and they're now below 310, and the chart is forming a bear flag pattern for now. Of course, Tesla's going to trade along with the rest of the market according to the FOMC outcome, but the technicals alone say that Tesla's getting toppy from an hourly chart perspective. And lastly, what about Bitcoin? Tulips, 4 hours chart. What's going on here? It is below 20,000. And this is not a good look. And if Bitcoin is a leading indicator, it is not saying good things about to happen. Because what if this is a beginning of an inverse ABC pattern? And we see Bitcoin forming a massive C leg to the downside at around 15,000. It is possible. We're watching and waiting for this outcome. The bulls are not out of ammo yet, but they need to fight. They need to close Bitcoin above 20,000 sooner than later. Otherwise, the tsunami of selling will show up and you will see Bitcoin at 15,000 very, very soon. So let's recap here. This is what I talked about on Sunday's video. I said the Dixie yields and the short-term VIX along with Tesla are in the bulls camp. Why? Because the Dixie and yields were overextended in the momentum indicators and the risk was to the downside. The short-term VIX was in negative momentum and Tesla looked really, really good, technically speaking. On the other hand, on the bears camp, the daily charts of the indexes, gold, the weekly VIX, Apple, Bitcoin. But here's what happened in the last 2 days. And I'm going to use a meter instead. Now look at this. The bears made significant advances, and the reason is they're keeping the daily chart of the indices. They're still bearish. Nothing changed here. Gold is still bearish. The weekly VIX is becoming even more bearish. Bitcoin turned even more bearish than Sunday. But now the Dixie's bull flag pattern is playing out, and therefore it is moving closer to the bearish camp. The short-term VIX is now forming positive momentum once again, so it is moving closer to the bearish camp. Apple, on the other hand, is moving closer to the bulls camp after 2 days worth of gains. Tesla moved slightly toward the bearish camp because we have the triple top right now, and it closed below 310. And then we have yields, be it the 10-year or the 2-year, still closer to the bullish camp. Why? Because the momentum indicators are really, really overextended, and we don't have, unlike the dollar, we don't have a bull flag pattern, for example. If anything, we're seeing weakness, a loss of momentum, sort of. So any good news from Powell, good news for the bulls, yields could go down dramatically, and therefore I'm keeping yields closer to the bulls camp. This is the pre-FOMC formation. A lot of things could change tomorrow. So buckle up your seatbelts. Let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? Of course, the most important event is the FOMC and the conference by Jerome Powell. But we also have data regarding the housing market, this time around existing home sales. So far for the week, the data we got from the housing market not encouraging at all. And of course, we're eyeing a lot of central banks making decisions tomorrow, not just the United States, but we have Brazil. But you might have heard today that the Swedish central bank increased rates by 100 basis points. So the Swedes kind of upped the bar for Jerome Powell to have the courage and do the 100 basis points. If Sweden can do it, then why couldn't the Federal Reserve? Folks, a critically important day coming tomorrow. Perhaps the most important Fed meeting since 2020. By far. Lots of action about to happen tomorrow. So I don't want to keep you up for too long here. You gotta catch some sleep. With that, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
I'm in bed.